Hi, my name is Aman and I am a CPA practicing in the Metro Vancouver region of British Columbia, Canada. To all of my clients and listeners, I would like to wish happy holidays, and I also thank you for all the support you gave me this year. At this time of the year, business owners like you are looking for tax strategies to reduce their tax burden. In this video, I will discuss key year-end tax planning ideas that may apply to you and your business. Salary versus dividends. The age-old question of whether to pay yourself in salary or dividends from your own company has gained increased importance, especially this year because of COVID-19. Let's discuss different aspects of this decision this year. Government support. You see, your company's eligibility and level of support under the Canada Emergency Business Account or CEBA and Canada Emergency Wage Subsidy or CEWS is primarily dependent on your company's payroll. If you are looking to get increased government support, then salary, which is part of your payroll, is the way to go. So beware that dividends will not help you to get support under these programs. Another essential thing to remember is the timing. You see, some benefits such as the Canada Recovery Benefit, Old Age Security, and Canada Child Benefit may be reduced as your income increases. So you may want to defer salary or dividends to 2021 in some cases. Always remember, a company enables you to control the timing and the amount of income you report personally. Loans and mortgages. If you are suffering from cash flow issues due to COVID-19, the need to mortgage, remortgage, or borrow money may increase. A consistent level of salary is often essential when applying for mortgages and loans. Dividends, especially when they have been irregular, may not help as much here. Employment expenses. You will need to have a salary against which you can deduct the employee expenses, especially some of the COVID-related employee expenses such as moving expenses, home office related expenses, and childcare expenses. Dividends are not useful as you cannot claim employment expenses from the dividend income. Liability for corporate taxes. Your company might be struggling with cash flow because of COVID-19. Now, as a result, your company might be facing difficulty paying the outstanding tax. Please keep in mind that paying yourself dividends could leave you personally liable for the taxes owed by your company. You see, this is not the case with salary, which is paid for your services rendered as an employee. Retirement income. Suppose the COVID-19 pandemic has caused significant decline of your retirement assets. You might be wondering as to how you will make ends meet in retirement. You see, if you want to collect Canada Pension Plan benefits, you will need employment earnings, which is salary, to participate. Dividends won't help with either the CPP benefits or the RRSP room. You may wish to withdraw enough salary from your private corporation by December 31st, 2020 to maximize your contributions to RRSPs and TFSA. These registered investment plans may offer benefits that are over and above the investments made through your company. If you have enough funds, receiving a salary of at least $154,611 can maximize your contribution to RRSP, which is $27,230 in 2021. Investment portfolios. You see, in this year, we saw sharp declines in stock exchanges around the world. Suppose you personally own a portfolio that has suffered a large decrease in value. In that case, you might want to consider the tax loss selling strategy, where you can sell your investments with accrued losses at year end to offset capital gains, which you might have realized elsewhere in your portfolio. Any net capital losses that cannot be used currently may either be carried back 3 years or carried forward indefinitely to offset net capital gains in other years. You see, for your loss to be immediately available for 2020 or one of the prior 3 years, the settlement must take place in 2020. Remember that the trade date must not be later than December 29, 2020 to complete settlement by December 31st. On the other hand, if your company owns a portfolio that has faced a decline, before realizing any capital losses, you might want to pay out capital dividends to eliminate any positive balance in the CDA. I have discussed this strategy in detail in my video on capital dividend account. You can click on the screen's top right to watch the video. Passive investment income in your corporation. If your company is approaching the 50,000 limit for passive income in 2020, you might want to consider a buy and hold strategy which can help you defer the payment of capital gains tax. You might also want to consider getting corporately owned exempt life insurance or individual pension plan, as income earned within these plans will not be regarded as passive income. If you want to learn more about this strategy, please watch my other video on this topic. Again, the link is on the screen's top right. Income splitting. Reasonable salaries may also be paid to family members who work in the business to contribute to their RRSPs and TFSAs. You might have other shareholders such as your spouse, partner, children, or other relatives shareholders. In any case, you should watch my video on income splitting. The link is on the top right to review the possible impact of the new TOSI rules. I recommend discussing with your CPA and legal advisors before paying dividends to these individuals in 2020. Take advantage of depressed corporate values. Now, if the COVID-19 has led to operating losses and there is also a reduction in the value of your business assets, chances are that the value of the shares you hold in your private corporation has decreased significantly. Now may be the time to buy out other shareholders as the value of the company has fallen. If the assets have declined in value, you might find that it is more cost effective to transfer the assets out of the company if you need to. If COVID has caused you significant cash flow issues and it is becoming hard to make payroll and retain key employees, you might want to consider giving them employee stock options. You see, the share values are lower and this tactic might minimize future tax on benefits. If you are looking for long-term tax planning to minimize future taxes on your death, you might want to introduce family members or family trust or do an estate freeze into your company's ownership structure. Tax planning should be a year-round affair. But as year-end approaches, now is the perfect time to review your tax planning strategies to reduce taxes. Be sure to speak to your CPA well in advance of tax filing season if you want more information on reducing your taxes. If you want to be notified about my new tax updates on tax planning tips and tricks, please consider subscribing to my YouTube channel. Thanks for watching and see you in my next video. Until then, bye.